now tuned into the Money Level Show.
Hello, everyone. Welcome back to the Money Level Show, where we think, act, and prosper. And today, I'm joined again by Peter Boockvar. How you doing today, Peter?
All right, Daryl. Good to see you.
You too. You too. So, what's been happening in your take in the markets? I mean, we saw a big rally after the election. The Fed came out and kind of poured some cold water on the hopes of the markets for future rate cuts. And so I wanted to get your outlook on the general equity market for this year.
I think the biggest story is what is going on with interest rates, where beginning in September of last year, the Fed has cut a total of 100 basis points, and long-term interest rates have done nothing but go up in the face of that. I think that's a variety of reasons. Number one, worries about inflation remaining persistent and possibly ticking up again. Recently, we've seen the price of oil approach $80. We've seen ag prices rally. We've seen copper prices rally. Also, I think growing worries, not just in the US, but globally with a lot of different countries, of excessive debts and deficits. Because rates are not just rising in the US, they're rising in France, in Italy, in Japan, and dragging up other countries like Germany and Australia, South Korea, Brazil having political issues, seeing rates rise there. So it is a global move to the upside. And I think for the equity market, it's sort of time for a gut check. Last couple of years, a big part of the equity rally has been PE multiple expansion. Earnings have risen for sure, but multiples have really accelerated the rise in stocks. So when interest rates are now, well, then you add in, of course, the hopes that Fed rate cuts, which helped that PE multiple expansion, were going to lower interest rates across the yield curve. There's somewhat of a reality check now that that is not the case. And the gut check is really for the multiples that we've now built in to stock prices in anticipation of a drop in interest rates across the curve that's now not happening. So I think that that's going to be the potential challenge for this year, and it's going to be more of a grinding type market rather than the easygoing path that we had in 2023 and 2024.
Mm-hmm. So what it seems like the market is addicted to low interest rates. I mean, that's like the anticipation that I'm hearing, at least from retail investors. Like Fed is lowering interest rates, assets are gonna go boom, and we do have this dynamic of the interest expense on government debt, which continues to. I mean, right now we're in excess, I think, of $1 trillion, $1 trillion, and so at one point, I mean, do you think there's going to be like a clash with the deficits of the government and the interest rates? Like, what do you see there?
I think it's taking place right now. And look at what's happening with UK gilt market as investors become worried about the new budget from the new Starmer government from Rachel Reeves. Look at what's going on in French yields as there's government turnover. Well, at the prime minister level, government turnover there, but worries about getting their budget under control to a 5 to 5.5% range of their deficit relative to GDP. Got Japan, which I think is a major factor in the rise in global interest rates, as they are expected to raise interest rates this month, in addition to every quarter slowing the pace of their QE. And you look at the price of gold. I mean, the dollar's rallying against a variety of different fiat currencies, but it's falling versus the price of gold. That tells me that investors now are much more focused on U.S. debts and deficits than they've been ever before.
Mm-hmm. Yeah, for sure. So with this dynamic of rates are rising everywhere. Then we have currently the Fed's doing quantitative tightening. Do you see them tapering that off at some point, or returning to QE at some point in the United States? What's your view on the Fed's moves? I know it can be hard to predict, but what kind of outlooks are you thinking there?
I mean, I think that they want to stretch out QT as long as possible. I think a few members like Powell and some regional presidents are still uncomfortable with a very large balance sheet, particularly relative to where it stood in February 2020 before they ramped it up in response to COVID. Shifting to QE, I think that's only going to happen if yields start on the long end start to spike in an uncontrollable fashion. If we go to 5, 5.5, 6 in a very rapid time frame, I'm sure the Fed will be back doing QE and trying to temper that. But then that's going to create its own potential side effects as well. But I think overall, I think the central bank is being put in a very difficult position, much of it upon their own making, but also challenges with the fiscal side and how the U.S. government is spending, north of $2 trillion relative to the tax receipts that they're pulling in, and that its deficit relative to GDP at 6% in a growing economy and a still low unemployment rate are definitely flashing yellow signals out there. Hasn't necessarily turned red yet, but the yellow flashes are taking place.
Mm-hmm. So, so with the current administration, administration that's coming in next Monday, a lot of the push was for the average American person, inflation. Even Donald Trump mentioned, inflation needs to come down, and he needs to defeat inflation and such. And so it seems like there's going to be some political pressure on the Fed, which there always has been, but I'm kind of wondering if it's going to intensify in the coming year, because I mean, yeah, like you mentioned, mortgage rates, home affordability, and all of these different things that the average person is experiencing, because there's like two different economies. You have those who are able to benefit from today's current environment, and you have those that are really struggling. And so, do you see that political pressure intensifying on the Fed?
Well, I mean, Trump the other day said he wants lower interest rates. So in a way, it's already started. But what lesson did we learn over the last couple of months? It's that the Fed can cut short-term interest rates. That doesn't mean that long-term interest rates fall as well. So there was a lot of people, particularly those interested in buying a home and those in the commercial real estate business, that thought Fed rate cuts were going to save the day. And they've done, if you're a SOFR plus borrower, did you see any benefit? But if you're borrowing off the longer end of the yield curve, particularly the 10-year, you've gotten not only no relief, you're back in the same pain that you were before the Fed started cutting interest rates. So even if Trump pressured the Fed and Jay Powell to cut, which I do not think Powell will succumb to, particularly with his term ending in May 2026, and the only thing him focused on being his legacy, even if Trump was successful in getting the Fed to cut short-term interest rates, if the market didn't like that move, you'd have long rates continuing to rise. So this is a much different situation than market participants have been used to in the 40-year bond bull market, and certainly, many people that just assumes that the Fed has full control of the yield curve. That clearly is not the case.
Yes, yes. Yeah, today's markets are a lot more trickier. I mean, for me, I didn't really get into investing until 2020, and that was like at the tail end of the where interest rates went to zero and everything, and that was like at the tail end where everything just started really skyrocketing. But now it's like the heat is coming on for investors, and trying to figure out where you can even park capital or whatnot to be able to make a living, or to be able to invest for your future, especially with retirement being in a crisis in many places in the nation. So for equities in particular, what's your view on small cap stocks under the current under the upcoming administration? And so they've been beaten up. There's been false hopes with the Russell 2000 at times, where it spikes and then it comes back down and such. And then the lower interest rates, many people thought that would boost these small cap companies and such. What's your view on small cap companies?
Well, it depends, because if you look at the Russell 2000, for example, around 35 to 40% of the companies there don't make any money. I'm focused on stocks that go up regardless of the market cap, but in the small cap space and stocks that we own, I'm very focused on health of the balance sheet. Most of them have cheap valuations, so I do think that there are a lot of opportunities in the smaller cap space, but investors need to be very active when they invest in small caps, not passive in an index. Uh, so there are definitely attractively valued companies with good prospects, good balance sheets, but we know that the dramatic underperformance in value stocks relative to the growthy, expensive stuff has been so wide. But if there's one thing that's going to close that gap, it could be this persistent level and rise in interest rates, where investors at some point start to question the high valuations of certain parts of the market and shift their attention to cheaper parts of the market. We've seen that in the past. I'm hopeful that we can see that again, because you can drive a truck through the valuation differential of the growthy stuff relative to everything else.
Yeah, and is your view that I mean, obviously, like you got like there's a lot of narrative investing. That's what I've seen. Like we went from the AI chips to chips to AI to quantum computing and and all of these things are just the charts are just going straight up on many of these companies, and then now some of them are experiencing a reality check. Um, what's your view on that? Like, because that seems like the space where some people who are like me, I like to do due diligence and understanding what I'm investing in, and one thing that really helped me is people like Warren Buffett, Rick Rule, who talks about having a 5 year horizon for my outlook or my thesis. But some people are trying to like, okay, I do want to make money in this market, and it seems like the companies that are being pumped or a lot of narratives are around is the way to go. And what's your view on that kind of mindset that investors may succumb to?
I mean, everyone has their own way when it comes to investing and trading. Everyone's got their own style. It has to suit your personality. I and really look at the investing world through a value lens. I'm attracted to beaten up things on the prospects of them eventually improving themselves in their business and their valuation in the eyes of investors. So there's no one answer. To me, time horizon is always the friend of an investor. The longer of it that you have, the more successful you can become, and the more noise you can sort of block out in the short term. To me, when you buy a stock, you're not just buying a stock symbol, you're investing in a piece of the business. And that's the way that I look to investing is, do I want to own a piece of this business? As opposed to speculating in stocks based on the hottest trend, whatever meme is out, whatever's trending, whatever momentum is there. Yeah, that can be fun if you want to play games with the market, but I don't think that that's necessarily a sustainable path to success in the market.
Mm-hmm. Yeah, yeah, definitely. Just a question on traditional finance getting more involved into Bitcoin and cryptocurrencies like BlackRock, Fidelity, and many others. And I was just wondering, what's your take there? I mean, 'cause I know you work for a firm or whatnot. What is kind of like the sentiment around these assets, especially with Trump's administration coming in, and you have many people that are pro Bitcoin or cryptocurrencies.
Well, certainly with the sharp rally that we've seen, there is a fear of missing out. We have advisors that have put some client money into Bitcoin, um, but it's a very personal decision. Some people don't get it, they don't understand it, and they don't want to own it. Others are intrigued by it, and they want to sort of capture this lightning in the bottle with the possibility of prices going higher. So it's hard to answer it in one sort of broad brush. Um, but we do want to be honest with clients. We want to talk to them about it. We want to talk about the pluses and minuses. And if investors are comfortable owning it, well, we'll own it for them. But also still laying out all the risks that are involved in owning it, and still admitting that we don't know where the price is going to go. We understand the supply demand imbalance, the finite quantity of it, but whether it sort of takes the mantle or joins the mantle of being gold in terms of it anti-fiat type asset, or is just a speculative asset like the Nasdaq, I still think that that remains to be seen.
Hmm. And how are you factoring in like the change in the regulatory environment that's coming up for it? I mean, this is an asset like I started, kind of playing around with in 2017, and I did not know that in 2025 we'll have a president and and an administration talking about it. And so it was kind of just like, okay, does this give it some more validity, as an asset class, and as well as the other black rocks and such. And so do you think that plays a difference in how people are viewing it just from what you're seeing?
Well, especially versus the last 4 years, where there seemed to be a war against crypto. Having a new president that is going to have more of a regulatory lighter touch, I think, is definitely welcome. Now, how that affects where the price of the coin itself goes, I don't know, but it certainly gave a lot of people more comfort that by owning it, it wasn't going to get confiscated by them, by some government bureaucrat. So at least for the next 4 years, there's an ease there. And certainly with BlackRock and other ETF holders, it's become much more institutionalized, which in a way is ironic because it was created to be the anti-institutional asset, and now it's institutionalized, owned by BlackRock among others, and blessed by the government or the incoming government. So um, it's definitely ironic in that from that perspective.
Yeah, yeah, for sure. It definitely is. But I also think like sometimes um, like assets that can perform well, like at some point, it seemed like okay, at some point the government's going to get more involved in this because they don't want to miss out on the money either. Like, so I was kind of thinking about that. But so what's your outlook on gold this year? So gold has been. I haven't looked at the price recently. I tend not to look at the price. I view gold as more insurance. And if I'm looking at it as an investment, I'm going to invest in royalty streaming or maybe some miners. But what's your outlook on gold this year? We saw a huge rise in it last year, a huge percentage gain. And so, what's your outlook for this year?
I'm still pretty bullish. Silver too, and I added another one to our portfolios, platinum. Uh, Gold still to me is intriguing, and particularly this persistent strength in the face of a sharp rise in interest rates and the value of the dollar. The dollar is rallying against other fiat currencies, but it's not rallying against gold. It's going down against the price of gold, which I think is pretty interesting. And as I said earlier, I tell on investor worries about U.S. debts and deficits. So I still think that there's upside, uh, and still trading as well, even as the market has taken away a bunch of expected rate cuts from the Fed. So it's doing what many people think it should not be doing. And I think a lot of that is because of the strong bid on the part of central banks for gold that want to own more of it rather than other, sovereign bonds.
Mm-hmm. Yes, yes. That's definitely what I've been paying attention to is I mean, obviously the weaponization of the dollar, which I don't know how that looks under the upcoming administration, but that piece as well as debt and deficits and central banks buying across around the world. Um, so platinum, you mentioned platinum, and I know we have to get off here shortly, but platinum, that's something that I've been kind of looking at. I've been looking at platinum group metals, and more particularly palladium and platinum, which were beaten up significantly. And so, what's your outlook there? What's intriguing you about platinum?
So yeah, they have been beaten up, and that's what got me to look more closely. I think it's about 80% of platinum is used in catalytic converters, and about 40%. I'm sorry, 80% of palladium, whereas it's about 40% for platinum used in catalytic converters. And I think what's giving these metals maybe a second life is uh, the ability of hybrids, at least right now, to win sort of this EV battle versus the full-on batteries. And that hybrids use as much to even more platinum and palladium in their catalytic converters as an internal combustion engine. So it's sort of giving it, I think a second wind. And at least on the platinum side, less so on the palladium, there's supply deficits for the next couple of years. So that's what intrigues me to platinum because hybrids are just very practical. and I think a lot more practical, at least right now with the current infrastructure, than a full-on EV. So I do think that uptake continues. It could be a nice tailwind for platinum.
Got it, got it. And so with a lot of the narrative around EVs was around like, okay, cleaner energy, reducing carbons and things of that nature. And now we have an administration where I don't want to paint it with a broad brushstroke, but could some parts of that administration could be anti ESG, anti climate change is a hoax, things like that. And so I'm kind of kind of wondering what outlook how does this look, moving forward, with like many of the investments, such as some of the metals, the mining, the materials like that we need to improve our grids or to electrify the world. And then also we had globally a lot of countries that were setting these carbon net zero goals and such over the last 5 years. And so I'm kind of wondering how that investment theme looks like moving forward, under this next administration.
Well, I still think that there's going to be a voracious demand for these key minerals, uh, because the electrification wave, I think, is only going to continue. Now, nuclear has gotten a tailwind to it for sure, and I think that that's going to be further defended by the incoming administration because nuclear is a vital piece of our energy mix, and it should be even a greater part of that mix, as it's certainly the cleanest and most reliable baseload power you can possibly find. But there's certainly going to be more demand for natural gas, more demand for LNG exports to the rest of the world that needs cheaper natural gas than they currently are paying. But there's going to be a broader mix. There's not going to be, physics hopefully is going to be respected in this new administration, where physics was sort of thrown out the window on this full-on push to solar, wind, and EVs at the expense of everything else.
Yeah, yeah, definitely. Yeah, I agree with that. So, Peter, where can people find out more information about what you do? I know I think you have a newsletter and such. Where can people go to find more about you?
So I do write daily on Substack. It's called the Boock Report, but you can just type in my name in Substack, and you can try on my daily market and macro and economic commentary. And then on the wealth management side, being the CIO of Bleakley Financial Group, people can go to our website and learn more about us.
All right, sounds good. Sounds good. Thank you, Peter, for coming on, and I'll be sure to link to those in the description below. You all be sure to go check out the Boock Report, as well as you can connect with Peter through Bleakley Financial. So thank you, Peter, for coming on, and looking forward to the next time.
Same here, Daryl. Thanks for having me on.